Good morning, everyone, and welcome to today's panel on equity compensation. I see a lot of people joining. We're going to give everyone just a couple minutes to get into the room, and we'll get started here in just a moment. Good morning, everyone. Okay, I'll go ahead and kick us off. We're still waiting for one more panelist to join, but we'll do a quick round of hellos and introductions. For those of you who don't know me, my name is Moeremans. I'm with the Arizona Commerce Authority, and I'm excited to be presenting this panel today. This is the last in our series on entrepreneurial finance for the year 2020. We'll be back next year with a new set of topics that we're really excited about. But for today, our focus, as you know, is on equity compensation, a really critical topic for this ecosystem, for founders, for mentors, to really get their heads around kind of that piece around equity. So I'm joined today by a stellar panel. Would love to have them go ahead and introduce themselves. Brenda, if you'd like to kick us off.
Hi, Brenda Schmidt, a serial entrepreneur here in Phoenix, always in healthcare, and then most recently joined Coplex as CEO. So excited about sharing some knowledge and wisdom from my 20 plus years of experience here.
Thanks, Brenda. Tom Spangler.
Hi, Tom Spangler. I'm the executive chairman at PrimeGov, which is a GovTech company here in Scottsdale, Phoenix. Formerly co-founder at Granicus, also in GovTech, and had an opportunity to work at Coplex as well. So really supportive of the ACA and everything that they do here to help the startup ecosystem.
Thanks, Tom, and we are appreciative of you and your time. And Mr. Curzon, Tom.
Yes, sir. I'm Tom Curzon with Osborne Maladon and also chairman of Startup AZ Foundation. And I've been basically, as a corporate lawyer, helping startups for about 38 years navigate these waters.
Fantastic. Thank you, Tom. And I'm also joined by my colleague today, Robert Theobald. If you'd like to say hello, Robert.
Hey, good morning, everybody. I'm Robert Theobald, the Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority.
Fantastic. And so today we will be taking Q&A from the chat. If you do want to throw it in there, I'll be monitoring that. I did see a question around kind of the previous 3 topics. We do have those recorded and posted on YouTube. I'll post the link in there once we get into the session in a moment. So for starting and kicking off today, I'm gonna,
You forgot Andrew.
Did he join? Is he there?
Yeah, he's there.
Oh, Andrew's there. He didn't pop up on my screen. Andrew, welcome. Say hello.
Hey, everyone. Sorry, I'm a few minutes late. I'm Andrew Miller. I am the head of finance and general counsel for an early stage food tech startup in San Francisco called Hero Foods. Before that, I was a corporate lawyer at a firm called Orrick Carrington and Sutcliffe and their tech venture capital group, where I represented companies from very early stage, 2 guys in a garage with not even a prototype, all the way to public companies. And I'm very excited to be here today, so thanks for having me.
Thank you, Andrew, and apologies. We were very excited to have you as well. So I want to get started with just kind of the overall picture of equity and compensation in general, and what the purpose behind that is. So Brenda, we spoke a little bit about this yesterday. If you could kind of just kick us off with, what are we trying to achieve here through this conversation on equity compensation, equity, but also just comp in general?
Yeah, I think as a small business founder, you're initially just trying to attract that management team, and you're like, oh, what is it going to take to get people to even, you're just blessed that someone even wants to join you on this crazy mission. And so I think the first thing is just to sort of start with a philosophy around what you're trying to accomplish. And a structure around that, because if you start it's that way and you've got the governance, the philosophy and the structure in place, it makes it a heck of a lot easier as you're in that growth phase and you're trying to add employees. So I think the first thing I always looked at is looking at it like total compensation. You know, you have the salary, you have bonus, you may have commission, and then you've got this piece for equity. And as you're hiring folks, you know, one or more of those things may be really important to them. And so it was always this bucket around total compensation that if you wanted more equity, you were going to get less salary and vice versa. And so I think having that structure in place early on with some type of bands and consideration for guardrails is helpful as you grow. So that's how I always looked at it. And I always looked at it as everybody should have some chunk of option grants in the company to have that support that culture and shared ownership around the alignment around mission and vision.
For sure. And Andrew, you mentioned as well kind of that philosophy around compensation. I'd love to hear you kind of talk about that a bit.
Yeah, it's something that early stage startups got a laundry list, and I know from experience, just a laundry list of 1,000 different things you're trying to do, and it's kind of a blank slate and not a lot of processes in place. The more investment you put up front and really thinking critically about these things, the better it will serve you over time. Sometimes I've seen companies get into a scenario where a director level and an analyst level have the same comp, and people, regardless of your company, people are always going to talk about their comp, and people are always going to know what everyone else is making. And so being thoughtful about how you structure comp, how you establish a compensation philosophy, and making sure that that's clearly communicated to new hires and existing employees is really going to help strengthen your culture. Brenda touched on equitizing everybody. It's a really powerful motive and incentive for people, not just the monetary benefit at the end of the day when you finally have an exit, but people really, they feel like owners of the company. One CEO I was talking to earlier at another company, he calls his all hands meetings shareholder meetings, and he's got his the entry stage employees at his company are like, oh, I've got to run to my shareholders meeting. People really feel emotionally and culturally invested, and the team and people are the most important thing you can focus on, especially this early in the game. So being thoughtful around that will pay dividends in the future.
Thanks, Andrew. So Tom Curzon, can you give us kind of an overview as we talk about these philosophies and equity compensation and how to align incentives, attract talent, motivate employees? What are the tools that we're working with here? What's kind of an overview of this equity conversation and what resources founders might have to kind of pull and play with?
Sure. And let me sort of give the framework. There's way more meat on this bone than we can cover today. So this is something to follow up with your advisors on, as I think we'll all highlight. So equity compensation is basically structurally driven by the intersection of tax, economics, and human nature. And the tax component of it is non-trivial. And so you don't want to mess around and think, oh, I can kind of wing it through this now and fix it later, because there are aspects of it that really can't be fixed later or at great cost. And I will tell you, sort of to perk up your ears, that the nightmare of when these problems get discovered is when you're in diligence for your venture financing or your M&A event. And the lawyers who are down in your underwear from the other side are exposing problems, and it's very expensive and very frustrating if you discover there are fundamental problems that happened at the beginning, which is one way of using a scare tactic to say, pay attention now. So here's kind of what you can have equity compensation in LLCs, S Corps, C Corps, and the like. It's sufficiently complex in LLCs and S Corps that I'm going to say, if you're one of those, you need to talk to your corporate lawyer, your tax advisor, because there's enough knobs and dials to turn there that it's have that conversation. The basics I'm going to cover are not far off even for them, but they are different in LLC land. And there are appropriate times when long-term equity comp can work beautifully there. But equity comp is basically, as Brenda and Andrew were talking, is in my mind, it is long-term comp. It is not short-term. And it's to give your teammates an upside in the business, right? They're going to help build value. It gives them a share of that value. The ground rules that are important for you to keep in mind as you think about this structure is really a couple tax concepts. There's a section in the code called Section 83 that basically says if you give somebody property, think stock, for services, and it's not vested, they have ordinary income right then in the value of that stock, okay? And if you put vesting on that, it defers the ordinary income until when it does become completely vested, and it's the full value of the stock at that time, okay? Obviously, if you gave your employees a bunch of stock, unvested when the company's getting going, that meets some needs in the sense that they've got equity, it'll have a low value at the time, but you want them to be vested most likely to stick around because it's long-term comp. If you do that, then it creates this very bad consequence of the harder they work, the more value they create. So when the vesting happens, they have a bigger tax bill. That's what gives rise to stock options. You will hear basically in long-term comp, restricted stock or restricted stock units on the one hand and stock options on the other hand. Restricted stock is a tool to use in the early days when the value was low, and you can give stock and put vesting on it at a low value to employees and use something called 83B, which is an election used at the beginning to create a terrific tax outcome, long-term capital gain opportunity for the employees or the advisors. But it really only works when the value is low. That's why we have the tool of stock options, which are so common. And for stock options, what happens is the shareholders approve a stock option plan or an equity incentive plan, and the board approves that. And then the board is responsible for granting options. And options are, for the simple description is it's the right to buy stock by paying the exercise price during the life of the option. And the simplest format is non-qualified stock options. You aren't taxed when they're granted. You're only taxed when they're exercised. There's a variation called incentive stock options where if you exercise and hold for 2 years and meet other qualifications, you can get a capital gain treatment. I'll tell you they're rarely exercised and rarely actually used. So basically you've got the tax event that occurs on exercise. The couple of ground rules that are pertinent to know is that you have to pay attention, or the board has to pay attention to exercise, to grant the options at fair value, or you create a nightmare tax problem under what's called Section 409A. So you hear about 409A valuations, you hear CARTA, one of the advantages of CARTA as a cap table program is they provide you on a SaaS basis or subscription basis 409A valuation services. So the key things to think about structurally are options are taxable when exercised generally, but not before. The exercise price is fair value, meaning you're going to want to exercise if you grow the value of the company above the exercise price. So that's the goal. And then the board can attach various contractual conditions to them, such as vesting. And I will tell you the standard vesting I see is 4-year vesting with a 1-year cliff, 1 year for the first quarter to vest, and then monthly, quarterly, or annually after that. Those are the basic ground rules, and options are extremely common. But they're the kind of thing you want to do carefully because they have consequences. Mark, I think I covered the highlights. Andrew and others can fill in around where I goofed it up, but that's the gist of the regime.
That is very helpful, Tom. And I'm going to come to Tom Spangler in a second to start to fill those in. But Tom Curzon, if you could just spend 1 minute connecting the dots between all of that overview framework and the cap table conversation that we had about a month or two ago, and where does this fall into the cap table?
Okay, good question. Typically, the options are for common stock. So they're on the common stock part of the cap table. And typically, in my experience, a startup will have reserved under the stock option plan somewhere between 10 and 20% of the total cap table for options to potentially be exercised. And generally, I would say 15% is the pretty common number. The number can be increased over time. Typically, what I talk with clients about is thinking about a pool the size that will cover your hiring needs for the next 12 to 24 months, depending upon your capital raising schedule. You don't need to authorize too many. It's irritating to not do enough, and because you just have to go back and get shareholder approval. So rough and dirty, typically 15% of the cap table is reserved for common stock options. They aren't outstanding until they're granted. And then the stock isn't outstanding until it's exercised.
Thanks, Tom. So now I want to take all of those tools and framework that Tom Curzon just talked about and kind of spread it over the types of roles that might be receiving this. So Tom Spangler, if you think about kind of who in the organization is receiving what types of equity compensation and when, maybe starting from the founder level or co-founder level all the way down, what you see or think is kind of standard or market, how they differ from group to group within those bands and buckets. And then we'll have others kind of join in on this tiering conversation. And you're on mute, Tom.
Sorry, rookie move. It's like having been on a Zoom call every day for the last year. I just learned a lot from Tom. I mean, just what a great summary. So you guys, I think that's awesome. You just saved yourself like $5,000 in legal fees to get the basic understanding. And then, you know, lawyers in your underwear. It's the first time I've heard that term, but I'm going to just go ahead and take that, Tom. That's what happens when you get an exit. So that's the price you pay for some sort of liquidity in the business, is somebody's going to go through every document basically in your business and check it out. To Mark's question, I think, you know, I always start, especially if you're early stage and you haven't done this or you're thinking about starting a business, you know, the founding group is just so important. I would say that companies fail. One of the main reasons early on is founder breakups. And so one, getting the team, but then getting the compensation and the ownership right is super important. When I was at Granicus, we had 4 founders, all equal. We all just wrote a really small check to buy our shares early on at what they called par value, which I think I paid $120 for 1 million shares in Granicus, which would be great now. And then with no restrictions. And so that came back to bite us. So kind of lesson learned for me is one of our founders ended up being defunct, just kind of walked away. Well, we asked him to walk away because he had basically not added any value in the business. And then we ended up having to buy him out in our Series A. So $3 million of our Series A, 10 million that we raised, 5 million total went to liquidity, but 3 million went to this defunct founder who hadn't done a lot. And so that could be avoided through some, you know, whether it's restricted stock units based on time or performance, some ways to get that kind of founder stock back, I think makes a lot of sense. While still getting, you know, all the really nice long-term capital gains, tax benefits that you get in the stock. After that, you know, my experience, and I probably lean forward on being more gracious, but you know, when we started Granicus, we had no money. We raised like a friends and family round. I think it was $200K. we ran out of money 3 times in the first kind of 3 years. So around February every year, we would run out of money. And so we needed some sort of currency to attract people. So we had a 20% option pool, and we gave out of that pretty graciously to early employees that were not really experienced in their career because we were all young, but I thought were kind of A players in the making that were key parts of our team that we needed. And so I think finding the gaps, the most critical gaps in your founder team, and pulling those in as those early hires and giving them, 1, 2, 3% equity in the business made a lot of sense to us. And especially when you're offering below market salaries. I think our 2 salary ranges at Granicus in the early days was $36,000 a year if you lived in San Francisco, which was like probably below the poverty level, or $30,000 if you lived somewhere else. That was how complex our salary bands were. And and we gave away a lot of equity. I'm a huge fan of a couple things on the equity. One, the culture alignment that you get with everybody being an owner. I would advocate to it in every business that I talk to. The alignment around what the real goals are. Nobody wins unless everybody wins, essentially, as shareholders. And it really just drives great alignment. We're all in this together, which I think is awesome. You are conserving cash if you're doing this right, and you're promoting the value of the stock and making sure people understand that there's value there. You should be able to get them for a lower compensation component. And then if you think about it, like, you don't actually ever have to pay for this unless, you probably as a founder are having a life-changing exit, right? So giving away 20% of what might be, $5, $10, $20 million exit for you. When you think of it that way, it's like, if I'm going to get a $20 million check, and now it's 16, and I'm going to give 4 to, this team on that 20%, then it's like, well, that really adds up for me. So I think your first 10 employees, 20 employees are probably getting really great equity. And then after that, it starts to be kind of broken down into smaller and smaller kind of what we would call points, so less than 1%. 1/10 of a point, or 1 point would be 1/10 of 1%. And then the ability to still bring in some key people when you need them. So I'd always save a little bit for that gap where you couldn't grow somebody from your organization into a role as you scaled. So you're always kind of trying to scale your people up at the same speed that you're scaling the business up, and you will have to circle back, and you might have to go give 1.5% later on to a really key person in the business. And then board positions too. We gave a board position, 1% to an outside director. The founder of Nimsoft came on our board for a while. Gary Reed, incredible entrepreneur, and was well worth the equity. Again, vesting over time. He doesn't make money unless we make an exit, et cetera.
So I want to dive a little deeper into this. Tom mentioned a few different categories of employee and kind of different ways of handling them. So he had the founder level or co-founder level. He had key executives. He had sort of early stage, the first sort of 10 employees. Well, he had what we call sort of rank and file, and then also potentially board members. And all of those having sort of different types of equity compensation and different phases. And so Brenda, Tom, and Andrew, I'd love to hear your perspective on how to handle those different categories. And then within that, I know at the founder level, is it an equal split? What if a founder leaves? What if I, the founder, want to leave and bring in a new executive to replace me? Those are the types of questions I think a lot of people have at this early stage. And Brenda, you're on mute. I see you trying to.
Rookie mistake. Yeah, I would add advisory board to that as well. So there's the board of directors, advisory board, employees, and trying to align all of that to be meaningful. But I know Tom talked in percentages, and I always try to stay away from percent, because if you put a percent in an offer letter and they're like, hey, do I still own the percent that you gave me when I first started? And like all of a sudden that 1% is Now, it's not 1%, it's a number of shares that at a certain point of time may represent a particular percent. So I always was really cautious around talking in terms of percentages, but I would give people scenarios around their shares and what that meant today and the value, because I think that's the other piece. I think that the founding team and in most instances, the executive management team understand option grants. But as you get further down in the organization, I can't tell you how many times people are surprised they have to write a check, either because they've left or they were, escorted, terminated, and then they actually have to write a check. And people don't, I don't think, understand tax implications, their own, financial situation. So I think that education becomes really, really important, because across the board, I think people have it's not something that they're typically familiar with as they're going maybe through a career in a larger company. But, I think for us, we didn't give a lot to advisors. It was kind of a penance of just, hey, keep them in the game. Because I'd really tried to find advisors that were much more committed and excited about the business I was building, as opposed to, hey, I'm going to have an upside on a liquidity event. Definitely independent board members had between, and I'm going to use percentage, 0.5% and 1% as they would come in. Because I wanted them aligned. Everybody had the same 4-year vesting cycle. We always had, 1-year cliff, monthly vesting. That was the same for everybody. I never changed it. But there was some flexibility in there. If somebody was leaving and they were, 3 weeks away from their cliff vesting, I was like, here, there's some flexibility there. But I never wanted to get into a situation where there was a ton of negotiation around options, because then it was just going to create a really matrix structure that I think was intended in terms of trying to be total compensation, making sure that there was a good balance of short-term and long-term equity, but that it was in a framework that people felt whole. And to Tom's point, there have always been bands. You have this amount of, this is your sort of level, and this is the band of equity compensation that you would get depending on how we're negotiating salary. So that's kind of how I've structured that.
That's helpful. Andrew, Tom, anything to add to those?
I would probably just say, and it goes to structuring your initial cap table too, and what that looks like and how much you reserve for your option pool is, and even how you're splitting equity among founders is, what skill sets do you have? What skill sets will you need in order to hit your business objectives? And you're really awarding, you're splitting up founder equity that way. Or knowing that, hey, we've got a strong technical founder, maybe the business founder isn't as strong, or we know we're going to need to hire a CFO in a couple of years, expecting, having that percentage kind of set aside or in anticipation of that hire. And then, I think within that, it's, again, going back to your philosophy and kind of the value that you think different employees will need, or the skill sets that you're looking to hire. And then understanding people's own personal motivations within each salary band. What we like to do is, some people are all about the equity. Other people just want to get paid in cash and think cash is king. And so giving them the optionality is like, hey, we can give you this base salary with a little bit lower equity, or if you're more interested in equity, we can adjust the base down in a little bit higher equity. But really only having that one lever to pull and trying to, staying within your framework, and helps to truncate negotiation around compensation usually.
I would also say, just to Tom's point, my very first company I started was with a co-founder. We both put in like a little bit of money. I think I put in $70. But then, we never thought, oh, what happens if somebody just checks out? And I had a similar situation where I had to buy that individual out, even though they weren't having any type of meaningful contribution to the company a year later. And so I think, really looking at those hard conversations is kind of like a prenup, around what's going to happen in these different scenarios, because at the time you're super excited about building the startup. You're not thinking about what the bad breakup might look like. And I think that's really important, as uncomfortable as that is to make sure you're planning for those scenarios.
So that ties into kind of the next way I want to look at this, which is more of a time constraint. So we looked at bands and kind of hierarchy, but there's also very different conversations and expectations and tools and frameworks at the earliest stages of a startup versus something that maybe they're at their Series A stage, or they're in that scale mode, bringing on more employees. And so I'd love to hear from those that have kind of a perspective on this, that how does that change over time? and what are tools that you can put in place, protections that you can put in place at the earliest stages, or if you're raising your Series A, this is how you should be thinking of it. But if you're just incorporating, this is how you should be thinking about it. And in the meantime, I'll ask, I see some questions around kind of standards and markets. If you have any quick tips or like, hey, it's always 20% for this, just throw that in the chat while some of the other panelists are kind of talking. So Tom, you're on mute, Curzon, but I know that you've got some views on early stage that you've worked with as well.
All right, I'm joining the rookie crowd. Honestly, I mean, I'll be interested in Andrew's take on this. There aren't many things that vary through time other than option price and the number of options. Early on, the value typically is going to be very low. So it's a quote bargain, there's lots of upside, but you're also huge risk, right? And so you're tending to give larger bites at the apple then. But the vesting is your primary protection. And then, terminating employees or having hard conversations is the way you implement that. It's kind of that simple. Or if it's restricted stock, I think Brenda and Tom have highlighted, it's absolutely critical in my mind that co-founders put on each other vesting to deal with the scenarios they describe. But it's still vesting, right? As the company grows in value, the exercise price goes up, and generally the risk goes down. The company has accomplished more, so the size of the grants gets smaller and the company's ability to pay normal comp goes up. So it's this trade-off as you go, depending in part on the risk, right? And how valuable is the company already? It's something very different to be giving option grants when the company is, where its future is highly in doubt versus say you're at $20 million of revenue and ramping fast and you feel good about its future and you're getting ready to do a big round. The world is different then, and you're giving much smaller grants, but you're still doing vesting. You're still protecting yourself in that fashion, and you're still having conversations with the people you're giving them to around the importance of this and creating value and what that value looks like from that day forward, because that's what's relevant, right? They're getting a piece of the upside from that moment. But I mean, that's how I look at it. Andrew, do you see it the same or different?
Yeah, I see it the same way. That vesting is your number one protection against low performers or non-performers. Within vesting, there are a handful of different flavors in terms of time-based vesting and there's milestone-based vesting. The plain vanilla approach with time-based vesting is, 4 years monthly with a 1-year cliff, meaning an employee has to stick around at least 1 year before their initial tranche vests, and then it's monthly after that. Usually within a few months of bringing someone on board, if they're going to be a good fit for that position or for your company or not, and you're able to course correct pretty quickly without having dead weight on your cap table. Milestone vesting, I typically like to stay away from. It's really, really hard to establish and communicate very clear milestones and a clear criteria for meeting those milestones. So time-based vesting, especially when its employment is at will, is that's kind of the standard approach.
And Andrew, on that point, I know Brenda mentioned earlier kind of a 4-year vesting schedule. We spoke yesterday, Tom mentioned kind of at some stage going from 1 year and then every month after that, more vests to make sure that people can be made whole. Tom, I don't know if you wanted to talk about kind of that process or differences in vesting schedules and when some might be better than others.
Yeah.
Honestly.
Oh, good.
Oh, go ahead, Tom.
No, you go. I think it's on you.
It's really a culture issue as much as anything, and kind of a hiring issue in terms of what's market. I think in the software and tech world in general, particularly in Silicon Valley, and now I would say here in Phoenix as well, monthly, 1 year cliff and then 36 months of vesting after that is pretty much standard in what people expect. And so you have to be competitive in your hiring, you have to meet that. Occasionally, companies who have the ability, bargaining wise, will do annual or quarterly, but those are the exception. I think, and as Brenda says, there's a tremendous internal stability value to having a standard that fits everybody, and that's it. And that tends to be what's done, because as soon as you start negotiating one-offs, you can create a multi-headed monster if you're not careful.
Yeah, I've seen standard. I teach entrepreneurship at NYU, and part of the course curriculum is sort of this interesting standardized advisor share document, and it's suggesting a 2-year vesting cycle schedule. But I'm on the board of a company that had a 2-year schedule for advisors, and they're 3 years in, and they're like, I can't get my advisors to engage. I'm like, well, do I need to pay them? And I'm like, well, it's because they should be aligned because they are fully vested, but at the same time, I think it should have been longer, because once those folks are fully vested, they're sort of feeling like, well, now maybe I don't have to lean in as much as I did initially to add value as maybe they have if they were continuing to vest those shares.
So there's an interesting thing beginning, and I'll be curious if it gets traction. And Andrew, you're in Silicon Valley, you may see some of this. I've started to hear about companies thinking about option vesting periods going out as long as 8 and 9 years, where basically the observation is time to exit is increasing. It's increased. It's now 8 to 10 years in general. And so some companies are, I'm told, I've not actually seen any, are starting to take that into account and putting in longer than 4-year vesting tracks. Andrew, have you seen that? I haven't.
A little bit. Yeah, you always get interesting, different new things going on with wacky startup founders in the Valley. I've heard, yeah, I've seen some founder, hey, if you're going to go with that approach, sometimes it's you got to walk, you got to live by it too. And that the founders that have implemented it have also implemented it on themselves. It's like, I have a 10-year vesting schedule, your vesting is exactly what mine is. So.
Just to jump in quickly, I do see a lot of questions coming in about LLCs, and so I want to carve out time at the end for that. Tom mentioned in the beginning there are some kind of slight differences, and so I'll give him time to address some of those questions. But for now, I want to kind of talk about managing this process. Tom Curzon, you mentioned creating kind of a multi-headed monster, which obviously there's enough complications in startups. We want to avoid any additional. So what does kind of good hygiene around this process look like? And how important is that in kind of a founder's sanity of just maintaining that good hygiene?
I'll jump in because I've been the brunt of Tom's kind of like due diligence investor. And you're like, what? Crap, we never actually got that person on the cap table. And so if you think about the process, you're given an offer letter and that may go through HR. And you get the person and they sign their offer letter. And then what? And then maybe that goes in HR and it does need board approval. So then you need to make sure that you're getting that option grant approved by the board at the next board meeting, reflected in either in the minutes or an approval. And then somehow that has to come back to whoever is managing your cap table to make sure that those shares then are, and that option grant is actually granted to that person within CARTA. Typically for new option holders, you would then give them access to CARTA. So it's not just a, hey, here you go, and they magically somehow, are appear. And so getting that process, because it has a lot of handoffs, right? That's typically where things kind of fall off from a hygiene perspective is that process isn't really well defined, and make sure it's going all the way from the negotiation and an offer letter to it's in the cap table. And that person has visibility and it starts to vest. So that's where I've seen it go wrong, is when there's not a process and there's a lot of handoffs, especially as the company grows and maybe different people have different responsibilities over time, and you're not thinking every day around your option plan.
Mm-hmm.
I'll echo that sentiment entirely. When early stage companies, option grants are usually ad hoc. You're having board meetings ad hoc. There's no regular schedule. Your hiring is kind of ad hoc as well, no regular schedule, and you kind of just get stuff approved as it comes in, and it's few and far between, so it's relatively easy to manage. But once you're growth stage, if you don't have a process in place, a really strong, well thought out process in place, employees will slip through the cracks. And I've seen that scenario where an employee, it turns out, 2 years later, it was discovered that an employee's option grant was never approved, and the value of the company has increased significantly during that time. And so there was a lot of money left on the table, and figuring out how to rectify that and do right by those types of employees is hard to do sometimes.
And that's like impossible math, right? Like, hey, we were going to give you 10,000 shares at $1 strike price, but now the strike price is $5. How many extra shares should we give you? Well, if you sell for $5.01, like you lost $4.01 off those other options. How do you make that up? But if you sell for $1,000, then does it matter? Is that much? It's just kind of impossible without an exit value. I'd like to say a couple things. I feel like everything's from the management side, but just to give you, if you're if you're looking to join a startup, like what are some of the things you should think about? And so this conversation is also important for the talent that's looking to join a startup, getting an offer for stock options for the first time. One, make sure it gets approved at the board, right? So I think that's a fair question to ask, is like, when is the board going to approve it? When do you redo your 409A valuation? Like, is that going to happen, in my offer? Is there a price listed? If not, kind of what's that value going to be? When's it going to get approved? And then I think to Brenda's point, she said about not talking about percentages. If you're getting an offer, a lot of times you'll see some number like, oh, wow, they offered me 50,000 shares. Well, 50,000 shares could be nothing. Like if they have 1 billion shares issued or authorized in the company, 50,000 is very different than if they have 10 million. And so understanding and asking, what's my percentage today? I think it's nice to be kind of a savvy employee who understands dilution, and you're going to take dilution later, and that's not a fixed percentage. But ask those questions, kind of figure out how your potential employer thinks about and understands the cap table as well. I think that's super useful. And then if you're offering people stock options as part of your comp, which I highly recommend, I couldn't recommend it enough to do, make sure that they value it. So one of the things that I see is that people will take the stock on top of the offer they would have accepted anyways. And that's not necessarily getting you the level of alignment that you want. Like I want somebody to take my job at a lower salary with an assumption of more work because of the upside in the stock options, right? So if you're an early stage startup, you're typically working a lot. This is not a 9-to-5 type job usually if you're getting a lot of equity. And you're going to get paid below market or a little bit below market usually. And then you're getting a meaningful kind of upside in the business. But I like to make sure you offer, as was said earlier, I like to offer 2 offers. Here's the heavy stock one, here's the heavy kind of cash one. And maybe I ask them that. And if they choose the heavy cash one, that resets my expectations if they're a right fit, right? Because if they don't believe in what we're doing enough to give up a little bit of their comp, market comp for the equity, maybe that's not the right fit for an early stage startup that's going to be cash constrained, that's going to need, best thinking from all their employees and run hard and all of those types of things that you typically get in startups. So couple comments there.
Yeah, Tom, I want to come back to culture in just a minute. Sorry, Tom Curzon. There's just one question that was on the hygiene piece around board approvals. Can the board change the strike price of stock options 1 to 2 years down the road?
Well, I'll take that one. So increasing the exercise price would require the grantee to agree, and you'd have a rebellion on your hands. So that's a crappy idea. Lowering the exercise price really signals you're in a down round scenario, and that's not a great thing. But sometimes you find you have to do it, and so the board can there because an employee is not going to do it, but you need to have a 409A valuation that supports the reduced price. Otherwise, you're going to create a 409A problem. So price changes are 409A issues, and they are human expectation issue, is the thing to think about. Because remember, the option award agreement is a contract. So it takes the agreement of the award recipient.
And I would add to that, once you have, especially like an institutional investor, like then your flexibility goes like way down, right? So it would be kind of bad form to do a repapering. Let's say it's the founding group and the first 5 employees, you've kind of got an opportunity to maybe fix things a little bit then. But if you've taken even your kind of seed round in, and now you've got a lot of other shareholders who are affected by that. And as founders, you can't make those mistakes going forward, because they're going to cost you. And I know speaking of the hygiene, we forgot a grant in our cap table for an intern, and it was 10,000 shares. And when we sold the business, the founders, we ate that because we wanted to make the intern whole from a decade ago. But our Series A investor certainly wasn't like, hey, we'll split that with you. That can come out of our side. I was like, well, that was your mistake. That's out of your side. And we had to kind of eat that.
So on this culture point that Tom, you were just starting to chat about, kind of making sure people see the value in it. It needs to be a motivating incentive. It needs to align kind of mission. I'd love to hear people's perspective on kind of other cultural implications, how it drives culture, how you can use it as a culture tool. And then also this piece around educating your employees around the value. So the transparency about it, how frequently you're talking about it. Is it kind of like in the offer letter and never again? Or are you having active kind of training sessions on here's how much your current stock options are worth? Would love to talk about that.
Yeah, I'll jump in. I'll try to be quick. We talked about it every quarter. I essentially presented our board report with some more fun added to it to the employees, what we call quarterly connect every quarter, and let them know exactly where we were on the business and our financial goals and our customer goals and employee satisfaction goals were a big part of that too. I think you should always be talking about it. I think the one caveat to be careful of, right, is people start, if they know enough about the financials of the company, they can start driving their own valuation, and sometimes they just get really out of control. So, they're looking at what an open table was valued at the time, and it's like, oh, these guys got 18 times revenue. If we multiply that, my share price is this. And then you go to a round and they hear the numbers much lower, or, you get an offer and everybody thinks it's a bad offer. So you've got to talk to them about how companies are valued a little bit too. I wouldn't spend too much time on it, but make sure that you're being realistic. I think you're always being aspirational of where you could get, but don't get so far out of line that everyone's disappointed no matter how good of a result you are at what you get.
We had an internal debate for a long time in the first couple of years at Solera, because I had an early CFO that was like, look, these folks that are across the company are not going to have the kind of meaningful exit that they think they are. It's too much administrative complexity and a pain in the ass for really the value that we're creating. But we ended up putting it in place, I think, primarily because it felt really disingenuous to have a big town hall meeting and celebrate, Series B or a Series C, when if you're an employee that doesn't have options, it's meaningless to you, right? Like you really aren't aligned around, hey, look, the valuation went up to this, and it's like, well, how does that impact me? I'm not a shareholder, and so I think it was important from a culture perspective to have everybody aligned around growing the company, but also being able to celebrate in those successes. And that, especially as you're, I think most of the folks on the call are looking at, high growth companies raising institutional capital. As you raise more money, I think that becomes more and more part of that culture. So I would agree with that with Tom. But I had people go, again, to the education piece. What does that really mean, and what is my potential upside? And so I would actually have a waterfall. Like, look, if you have X number of shares at these exit values, this is what this could potentially mean to you. Like, not guaranteeing it, but just for realistic expectations. I think people have this kind of Silicon Valley, I'm going to be a millionaire because I have shares in an early stage company. And so I think setting those realistic expectations. It's great to have the upside, but there's taxes and there's, reality that needs to be there too, especially for folks who aren't early founders.
So we've got a few minutes left, and I still want to save time for the LLC questions that have come in. But if anyone has sort of kind of traps to avoid, horror stories that you've seen, mistakes that you personally have made to kind of warn people on the call of watch out for these areas, I think that those are always helpful to kind of learn from. And then we can hit the Q&A as well.
Well, there's one thing that Brenda just mentioned that I just want to add to. The taxes on options on an exit, are pretty brutal, right? So you're taking just regular income on those if you're an employee who's just selling into a deal, and being able to talk about that. And if you keep your strike price low enough early on, allowing some people, encouraging people to buy some. We had some employees who had bought some of their options before because the price was low enough, and they did much better, obviously, with long-term capital gains on their stock than they did with employees just kind of taking that huge haircut on the option taxations.
It's a great,
yeah. I would say a couple of things. Don't give away too much too early. I mean, if this company to an exit is going to be 7 years, 10 years, you may have to turn over your executive team a couple of times. And assuming some of those people have already vested at least 50% of their options, just making sure that you're not assuming that what you're giving to that founding team is going to last you until an exit. And I think the other piece that I would caution is don't use equity as a bonus. A lot of employees say, hey, as opposed to a cash bonus, can I just get more option grants? And so I always really steered away from using equity as a quasi incentive plan, especially in times when cash may have been tough. Because that starts to, again, kind of mess up the framework and the structure. I don't know. I would love to see how if anybody else used option grants as part of their bonus structure.
I have done it before. I agree, though. I think Andrew said earlier not to have like vesting based on kind of projects. I like time-based vesting, and then for people who hit really clear goals, sometimes there would be additional grants, but we would usually, Brenda, do it as not vested, but new option grants, right? So like, hey, you earned, like if you get a promotion, usually you would get additional shares because of the new role. And so we would do that sometimes based on like, oh, we hit a goal, here's another 10,000 shares, but they're vesting over 4 years still, right? So now you're re-upping people into, and I think that is important to think about the end date, because a lot of people do look at like the advisory thing that you brought up. Oh, I vested all my shares now. Now I'm not getting paid what I should be paying. I'm not vesting any new shares. Now they're still creating value in increasing the shares that have vested. But a lot of times people do want some additional shares, and having that conversation with them. Hey, when you were employee number 7, we gave you 100,000 shares because you're early. Now that you've got a promotion, we're not giving you another 100,000. That's kind of out of market for this promotion. We're giving you 10,000. And they're like, oh, that doesn't seem much, but hey, that's what people are getting now when they join. That's why we're giving you this kind of smaller amount. You've got to kind of be able to have that conversation and have the framework to balance back on so that they know it's all equitable, because they do talk. So.
Okay, Tom Curzon, if you wouldn't mind, can you take us through some high-level thoughts around LLCs?
Sure. So LLCs are typically taxed as partnerships. So that's a whole separate regime of tax law. The opportunity in that context for equity comp that's pretty cool are things called profits interests, which are basically the ability to have a share of the upside. And there are ground rules for how you do that. If you comply, a couple of the advantages are, one is there's typically not a strike price. You don't have to pay for it. You just get it. And if you hold it a required period of time, you get flow through long-term capital gain treatment instead of ordinary income that you get with stock options. Those are very cool. The economics are essentially the same. Instead of a strike price, you have a hurdle rate or a threshold, or basically the idea is that the owners of the company, before you come in, get their money out before you start getting your share of the appreciation. And then there are typically restrictions, investing, and kind of all of that stuff that's put in. One of the wrinkles in LLC land, because it's a partnership, the recipient under the tax rules, the holder of a profits interest is a quote partner, and therefore can't get a W-2. And you end up having to do quarterly estimated taxes, you get K-1s and the like, which is very unappealing for broad-based employee incentive programs. You can do options in LLC units, but if they exercise, and that doesn't mess up getting W-2s, but if and when they exercise the option, then they face the no longer getting W-2s, et cetera, unless you do workarounds that are available and complicated and whatnot. So it's doable, and I've got clients doing both of those things. And there are some scenarios, Brenda and I have chatted about one, where you're really wanting to have a small group of people have long-term equity interest, and they understand profits interest, and it can be perfect for that kind of a scenario. But for your typical growth company, where the investors are going to want to invest in C Corp stock so they can get potential 1202 gain and the like, you're going to be in C Corp land, and it's all of the stuff we've been talking about. So the LLC world is administratively more complicated, and you're going to have more involvement of your tax lawyer and tax CPA. So it's not really the land of growth companies as much as it used to be before 1202 became a real thing, in my experience.
And for those on the call, we've mentioned this previously, but it's probably worth repeating. LLCs, if you are considering kind of a venture institutional growth path, it is a little bit more difficult as an LLC, as the standard expectation for VCs is that you'd be structured as a C Corp. And so just want to remind people of that if they haven't participated in the past, if that's a path they're thinking of taking, wanting to put yourself in the best kind of legal position for venture growth. Okay.
A little more difficult is an understatement. I think it's very almost impossible to raise institutional money in an LLC, and the conversion, depending on your history and structure, is like very painful to do. So if you're going down that path, do a C Corp, Delaware C Corp, and start out on the right foot.
So we've got maybe 1 or 2 minutes left. I'll try and do rapid fire questions. Could talk about profit sharing pools as an alternative to equity? And Tom, you might have just touched on that a little bit. Also, phantom STK or SAR grants.
The short version on profit sharing pools and FAM grants and the like. Yes, you can do them. You believe it or not, you have ERISA and 409A compliance that you have to deal with if you're going to have the possibility of the recipients taking their grants with them after they leave the company. So those are complicated things that you need to talk to a 409A and ERISA lawyer, et cetera, which is its own expensive little problem.
And lastly, I guess I'll just ask anyone on who has a kind of opinion, if you're early stage, you haven't been through the fires yet, what's a great source to learn more? Where can people go to kind of dig through this so that it's not just tribal knowledge, but can be studied up on to avoid some of these mistakes?
Go ahead and jump in and tell you a lot of what I read. Fred Wilson, who's a VC out in New York, has a great blog, and every now and then he'll cover a lot of this stuff. Brad Feld, who's at Foundry Group, has written several books and kind of dives into term sheets and venture financings and even the corporate hygiene and thinking about option pools and option grants. If you really want to get into the weeds on legal, I think the book is called The Entrepreneur's Guide to Business Law by a lawyer at a firm called Cooley named Craig Douchy. That is, if you really want to get in the weeds, that's a great one. And it's got a good chapter on equity comp and the difference between ISO and ENSO options and all that stuff. That's my 2 cents.
Yeah, have a good attorney who's really specialized in startups, which is very, very different than just sort of general business attorney. So we've always just really leaned on our attorney friends.
All
Yeah.
right. Oh, go ahead, Tom.
Don't cut that attorney expense early on. It's way more expensive later.
Mhm.
So we went through that. We didn't have any money, so we kind of ham and egged it together, and then the cleanup was expensive. So.
Well, I want to thank our panelists for their time this morning. A really very helpful conversation. I hope it was informative to those on the line. Thank you to those that stuck around and participated. A special thanks to Tom Curzon for helping me organize this entire series of panels. I'm excited to come back in 2021 with the next series for all of you. If you've got thoughts, opinions, suggestions, asks for the types of topics you want to learn more about, please send those to me either in the chat or at my email. But other than that, I hope everyone continues to stay safe and have a really happy holiday season. And I look forward to continuing the conversation next year.
Adios.
All right.
See you guys.
Adios.
Happy
Thank
holidays.
you.
Yep,
Thanks,
bye-bye.
everyone.
Bye.